Hello and welcome to our video on auditing evidence part 1. We're going to have a second part going into a little bit more detail with this, but first of all I just wanted to cover some of this information. So this part 1 will cover the types and hierarchy of evidence. Now, when we talked about the generally accepted auditing standards, you may recall the third fieldwork standard required that we obtain sufficient appropriate evidence to support the audit opinion that we're going to issue. So we're talking about evidence in this particular section, but there are a couple of terms that came up in that definition here that deserve some discussion. Sufficiency and appropriate. So the sufficiency of evidence, what makes evidence sufficient? In other words, when do we have enough? This is talking about the weighting of evidence. So we have different types of evidence that could come into play. What quality does each type of evidence possess? So that's really what we're going to get into there. The hierarchy of evidence, which is the weighting itself. So what's the most important evidence? What would you prefer to have? And what is the least weighted evidence? And then we could just be talking about the quantity of evidence that we have. All these different types of documents, all these interviews, all these personal observations, and then just the mixture that we have. So those things feed into the sufficiency of evidence. Now, whether evidence is appropriate depends on a couple of things. First of all, is it relevant to the decision at hand? Is it relevant to what we're reviewing? And is it reliable? If the evidence is not reliable, then it's not really going to be appropriate. And that kind of feeds into the sufficiency as well. It carries a much lower weighting if it's not reliable. So once we determine how sufficient that audit evidence is and how appropriate it is, that allows us to determine how persuasive it's going to be if we decide to use it to help us support our opinion in our audit report, all of our findings. We document that in our work papers. So that's really the goal here. So when we're talking about sufficiency, let's go back to that hierarchy of audit evidence. And we're going to start at the top, the heaviest, most heavily weighted audit evidence would be the auditor's personal knowledge and their observation. So this is where they've seen something, they've tested something, and they've physically examined it. We're going to see all of these in later slides as well. But basically it's a high weight because the auditor knows it firsthand. They're not having to rely on anybody else. They're not having to question whether they can trust anybody else. They've seen it, they've inspected it, they've recalculated it. The next level of evidence would be external documentary evidence. So this is information that started from an outside party. And we'll talk more about some different aspects of that later on. The next level down would be internal documentary evidence, and we're talking internal to the client. So we're auditing the client, but this information is coming from them. As you can imagine, there's some question as to the source. Can we trust it? Is it reliable? Then we go further down and we get analytical procedure evidence. So this is us reviewing some relationships between some of the account balances. Does it make sense? The reason it carries a relatively low weight is that it doesn't really prove anything. It may give us some red flags to dig into more deeply, but it doesn't really prove anything. And then finally we get to the testimonial evidence, which is just somebody's word. And it's usually we're talking about the client themselves, one of the employees or the accountants or even management. They're telling us something. Now, the reason that's the lowest weighted is that they, being internal to the company, they certainly have an incentive to be less than truthful, if you will, spin things their way, omit certain things. They're just trying to tell us what they think we want us to hear. Now, again, I'm not saying this happens all the time. We assume during this we have professional skepticism, so we assume there's the potential for them to be either lying to us outright or misleading. Again, the vast majority of the time, they're going to be honest and truthful, but you always have to be aware of that potential. So let's go through those in more detail. The auditor's direct observation. Now, this one we're going to see a lot more of in part two, but again, we gain this through the observing something. So we observe how the client is doing something, how the controls are working, how the inventory is counted. Physical examination, if we question whether or not the inventory really exists, we can go physically examine it. Maybe we can open up a box and test sample it to make sure that, yeah, it contained as many units as it said on the box, and they appear to be what it says they are. So when they count that as inventory, we can rely on that. Inspection, kind of just another word for that. Now, recalculation, this is when we're looking at an actual amount. We could be looking at something like a sales revenue balance, and we could take a look at the various invoices, multiply the unit counts by whatever the price was to determine what the total price should be, and make sure it just matches out, foots out, and everything. So that'd be recalculation. Reperformance is very similar, but reperformance might be even with a control. You might be reperforming a control to make sure it works as it was supposed to. So again, these are covered more in part two. Now, when we get to the external documentary evidence, well, again, the question is, this came from an outside party, so it's something generated by an outside party, third party, unrelated to the company. But the question is, who was it sent to? Was it sent directly to the auditor from that outside source? This would be like an accounts receivable confirmation or an accounts payable confirmation letter. A lot of times, yes, the client has to approve us sending those out, but the letter that it gets sent out into has the auditor's address as a return address. So the responses will come straight to the auditor. They don't go to the client. Because there's obviously a concern if they went to the client could hide whatever they didn't want the auditor to see. So there's that information. Those would be the best at least of this external documentary evidence. If it's sent directly to the auditor, we can rely on it more heavily. Now, if it's sent from the third party to the client, and then the client passes it back to us, this is not as heavily weighted. It's still external, but there's the potential that the client has done something with it. Now, that would be pretty much fraud at that point if they intentionally mess with a document that came from an outside party. If they changed in any way, that's certainly fraud. But we're talking like a bank statement or invoice from a third party, things like that. Now, again, that last level we have, not the last level of documentation was the internal client provided documentary evidence. If this information was prepared by the client or prepared by the company, then it's less reliable because obviously the client could have made changes to their own work if they wanted to make something look better. So these are things like accounts receivable subsidiary ledgers and schedules, depreciation schedules, fixed asset subsidiary ledgers. These are just a few examples of it. So a couple of questions. Can we rely on this information knowing its source? Is there any other way to corroborate that information, to verify it? Does it make sense? Does what they've sent us make sense based on what we've seen from a big picture? Then we get into the analytical procedure evidence. So analytical procedures are somewhat odd because they can be used in multiple steps of the audit. In fact, they can be used in three phases. The planning phase, just to identify where do you think the risk is. They can also be used during the actual audit work, and they can be used as a wrap-up just to make sure your adjustments, after your adjustments, everything still makes sense. The problem with ratios is that there might be certain things that you find that are either illogical or possibly they just flat out impossible. But the problem is proving that error. So it might give you a red flag that an error exists, but it's hard for the ratios themselves to prove that this number is not correct. Here's what the proper number should be. It might be able to tell you that this number doesn't seem right, but it's probably not going to tell you what the true number is. So because of this, it's providing limited assurance. Now the good news is if we do find everything that is in line with what we expect, it gives us a little bit of extra assurance that, yeah, we didn't make any mistakes, we didn't miss anything. These numbers seem to make sense. They match what we would expect. Again, it's not proof either way, but it's better than not having anything at all. And finally, we're talking testimonial evidence. We're generally talking about actual verbal responses from the client. Now, we'll probably be taking notes about them, but regardless, it's not written information. Otherwise, it would be back at the documentary evidence section. So these are not permanent, other than the fact that we could be making notes. The client is the one that issues these. And again, it has low level. It's the very lowest level of evidence. So we should only use this if we have some way of corroborating it, or if we're able to live with the very limited assurance that it's giving us. Maybe the risk is so low to begin with, or there are so many strong controls in place that we're not as concerned with detection risk, minimizing that. Maybe we're fine with this limited level of assurance. So now let's talk about the appropriateness aspect of all of this. This gets to relevance and reliability. So again, with relevance, does this pertain to the audit objective we're trying to accomplish? Or does it pertain to what we're trying to prove? If it doesn't relate to what we're trying to review, then it's just wasting our time even looking at it. Reliability. So how much trust can we place on the evidence, and more importantly, how much trust would other external parties, like a user, like if this ended up in court, how much trust would they be able to place on the evidence given all the aspects of it? Now, the last thing about reliability, are there various levels of evidence that help to corroborate one another? They're consistent with one another, so they tell the big picture and they tell the same story. That certainly adds to the weight of our findings. Now, the thing with reliability, we have to consider what we're actually trying to review. What is the objective? Evidence that's relevant for one objective may not make any sense for another objective. It may have nothing to do with another objective. So relevance is definitely based on what we're trying to review. You have to pay close attention to that. And reliability here. So we have a few different aspects of this to talk about. Some of them we've touched on a little bit, but the independence of the information provider, are they closely related to management? Is it coming from management themselves? If it's a completely unrelated party and this provider, this client, does not make up a large percentage of their business, then they're considered pretty independent. There's no real reason for them to lie. There's no pressure that management can put on them. So that helps the weight of that evidence. The effectiveness of internal control, when any of these documents are gathered by the company, if we've already determined that their internal control systems are pretty strong, then that helps us to be able to rely on the information more. Auditor's direct knowledge, obviously if we have some direct knowledge of that, then that makes things more reliable. Just the flat out qualifications of information providers. So it's important that they're independent, but they also need to know what they're talking about. So they have to be competent, they have to have qualifications to provide that information. It's not some uneducated opinion, it's somebody that knows what they're talking about and providing an expert opinion. The degree of objectivity kind of ties back down to the independence. So how close are they to this company? Is there any incentive, any reason they would be subject to some emotional type response for providing this information? Fear, pressure, anything like that. Loyalty even. Things like that are a concern because we may not be getting the whole picture. And then timeliness. Timeliness ties into reliability and also relevance. When are we getting the information? Is this information being provided quickly, right after we request it? Or is this taking them a while to respond, which then our concern is, are they fabricating evidence? Are they taking time to get all their stories straight? Or are they just responding with a quick response, which is more likely to be the truth? So now in part two of the lecture, we go into some more details about those types of evidence. But this part was just to cover just kind of the concepts, the weight, the hierarchy, the high level things like that. Just some things to consider as you're going through an audit. So hopefully this helps to start our discussion, and I will see you in part two of this lecture.